Dividend investing, explained in plain English, how they work and why they matter. You've probably heard the word dividend investing tossed around, but what does it really mean? Let's break it down in simple terms. When a company makes a profit, it can do a few things with that money. It can reinvest it into the business, hold on to it, or if it wants to reward shareholders, it can pay some of it out. That payout is called a dividend. If you own 100 shares in a company that pays a $1 dividend per share, that's $100 straight to you, just for owning the stock. Most companies that pay dividends are big, stable names like Coca-Cola, Apple, or Procter & Gamble. But there are plenty of smaller companies across industries that pay dividends too. So how do you actually get these payments? Dividends are usually paid every quarter, but some companies pay monthly or annually. There are a few key dates to know. First, the declaration date, when the company announces the dividend. Then comes the ex-dividend date. You have to own the stock before this date to get the payment. After that is the record date, which is when the company checks who's on its shareholder list. And finally, the payment date. That's when the money hits your account. Just a heads up, on the ex-dividend date, the stock price usually drops by the dividend amount. It's not a crash, it's just an adjustment because new buyers after that point don't get the payout. There are different types of dividends too. The most common is a cash dividend, which goes straight into your account. Then there are stock dividends, where instead of cash, you get more shares. Less common are property dividends, where a company might send out assets or other investments. Why do companies even pay dividends? It's a way to reward shareholders and show confidence. If a company keeps paying or raising its dividend, it usually means they have stable cash flow and solid earnings. Investors tend to see dividends as a sign of financial health. So what's the upside of dividend investing? First, it gives you steady income. That's a big deal for retirees or anyone looking to generate cash without selling stocks. Second, you can reinvest those dividends and buy more shares, helping your investment snowball over time. And third, dividends offer some protection during rough markets. Even if your stock price dips, you're still getting paid. Dividend investing, especially if you reinvest the dividends, can yield incredible returns over a long period of time through compound interest effects. Let's talk about what happens when you reinvest your dividends instead of just cashing them out. Take Coca-Cola, for example, a classic dividend stock that's been paying shareholders for decades. If you invested $10,000 into Coca-Cola stock back in the year 2000 and you didn't reinvest the dividends, your investment would have grown to around $40,000 by 2024. But if you reinvested every dividend along the way, that same $10,000 would have grown to over $75,000. That's the power of compounding. Every time that dividend hits your account and gets turned into more shares, you're setting yourself up to earn even more next time. But there are a few downsides. Dividends aren't guaranteed. If a company hits hard times, it can cut or cancel its dividend altogether. Also, some dividend income is taxable as ordinary dividends. And if you're in a higher tax bracket, that can reduce your returns. Don't be fooled by sky-high dividend yields. Sometimes a stock is paying a high yield because the price is dropping, and that could mean it has to reduce its dividends soon. If you're picking dividend stocks, focus on a few key things. Look at the dividend yield, but don't just chase high numbers. A balanced yield with consistent growth is usually better. Check the payout ratio. This tells you how much of the company's profits are being paid out. Also look for companies with strong earnings, low debt, and a long track record of paying dividends. Some companies have raised their dividend every year for decades. They're known as dividend aristocrats. Want to take it a step further? Reinvest your dividends. A lot of brokerages let you set up a DRIP, a dividend reinvestment plan, so those payouts automatically buy more shares. That means you're earning returns on your returns, and that kind of compounding can really grow your portfolio over time. Finally, it's not about choosing between dividend stocks and growth stocks. A smart portfolio often has both. Dividends give you income. Growth stocks give you potential upside. It all depends on your goals and timeline. So whether you're investing for income, stability, or long-term wealth, dividends can play a powerful role in your strategy. Understand how they work, reinvest wisely, and keep an eye on the fundamentals, and you'll be on the right path. Follow and subscribe for more. Level Fields, Elite Investing, Effortless AI.